Hey, welcome to today's podcast episode, and I'm your host, Abraham Emas. For our new listeners joining us for the first time, I say a big welcome to you all. This is Abraham's Ideas Podcast. You can hit on the subscription button and the notification bell to be the first to access all my new episodes. In our previous episode, I started a financial management series where I spoke about understanding financial statements. And in today's episode, I will be covering the aspect of financial analysis. Financial analysis is an important topic that helps individuals and organizations understand the financial health of a business, and it involves examining financial statements and other financial data to evaluate a company's financial position. In today's class, I will cover the basics of financial analysis, and I'll be taking them step by step. Step 1. Introduction to financial analysis. What is financial analysis? Financial analysis is the process of evaluating the financial health of a business by examining financial statements and other financial data. It involves analyzing the financial performance, profitability, and financial position of a company to make informed decisions about its future. Importance of financial analysis. Financial analysis is important because it helps individuals and organizations make informed decisions about the financial health of a business. By analyzing financial statements and other financial data, individuals and organizations can evaluate a company's financial performance, profitability, and financial position. This information can be used to make decisions about investing in or lending to a company. Key financial statements. 3 key financial statements are used in financial analysis. The first is the balance sheet. The balance sheet shows a company's financial position at a specific point in time. It lists a company's assets, liabilities, and equity. The second is the income statement. The income statement shows a company's financial performance over a specific period. It lists a company's revenue, expenses, and net income. The third is the cash flow statement. The cash flow statement shows the inflow and outflows of cash for a specific period. It lists a company's cash from operating activities, cash from investing activities, and cash from financing activities. For more insight on the 3 key financial statements used in financial analysis, check out my previous episode on how to understand financial statements, which is understanding financial statements. Let's move on. Methods of financial analysis. The first method we're going to be looking at is ratio analysis. Ratio analysis is a method of financial analysis that involves calculating and interpreting financial ratios. Financial ratios are used to evaluate a company's financial performance, profitability, and the financial position. There are 4 main categories of financial ratios. The first is the liquidity ratio. Liquidity ratios measures a company's ability to meet its short-term obligation. Examples of liquidity ratios include the current ratio and quick ratio. The second is the profitability ratio. The profitability ratio measures a company's ability to generate profit. Examples of profitability ratios include the gross profit margin, the net profit margin, and the return on assets. Efficiency ratios. Efficiency ratios measures a company's ability to use its assets efficiently. Examples of efficiency ratios include the asset turnover ratio and the inventory turnover ratio. The fourth is the solvency ratio. The solvency ratio measures a company's ability to meet its long-term obligations. Examples of solvency ratios include the debt to equity ratio and the interest coverage ratio. The second analysis we're going to be looking at is the vertical analysis. Vertical analysis is a method of financial analysis that involves comparing various items on a financial statement as a percentage of a single base item. For example, on an income statement, each expense item can be expressed as a percentage of total revenue. This allows for easier comparison between different periods or between different companies. Third, horizontal analysis. Horizontal analysis is a method of financial analysis that involves comparing financial data over some time. This can be done by calculating the percentage changed between two periods for each financial item. Horizontal analysis can be used to identify trends or changes in a company's financial performance over time. The fourth is the DuPont analysis. DuPont analysis is a method of financial analysis that involves breaking down a company's return on equity into three components, and they are the net profit margin, the asset turnover, and financial leverage. By analyzing these components, DuPont analysis can help identify areas where a company can improve on its return on equity. The final step, which is step 3, is steps in financial analysis. The first step is collecting financial data. The first step in financial analysis is to collect relevant financial data from different sources. The data can include financial statements, tax returns, bank statements, loan agreements, and other financial records. It is important to ensure that the data is accurate, complete, and up to date. The second is analyzing financial data. After collecting the financial data, the next step is to analyze it. Financial analysis involves examining the data to identify trends, patterns, and relationships that can provide insight into financial health of a business or a company. Financial ratios such as liquidity ratios, profitability ratios, and debt ratios. These are commonly used to analyze financial data. The third is interpreting financial data. Once the financial data has been analyzed, the next step is to interpret the results. This involves making sense of the findings and drawing conclusions about the financial health of the business. For example, if the liquidity ratio is low, it may indicate that the business is not generating enough cash to meet its short-term obligation. The fourth, which is the last, is reporting results. The final step in financial analysis is to report the results. This involves preparing a report that summarizes the findings and presents the conclusion clearly and concisely. This report may be used by business owners, investors, lenders, or other stakeholders to make informed decisions about the business. It is important to ensure that the report is accurate, objective, and easy to understand. So this will be the end of today's podcast episode. In my next episode, I will be covering the aspect of budgeting. Thanks for listening. I will see you in the next episode.